Good afternoon, Jane and Gabriel. Thank you for entrusting us with your financial planning. As you approach retirement, you're in a strong financial position with $500,000 in savings and an expected age pension of over $37,000 a year. With 5 years away, you have a medium-term investment horizon, requiring a balanced approach, with growth to keep pace with inflation, but a shift towards more stable income-generating assets to reduce risk as retirement nears. You want to maintain your current lifestyle and are comfortable with moderate investment risk, avoiding major swings in income and peace of mind. 4% is a practical guideline for withdrawals, but has its limitations. Your expenses will include predictable and unexpected costs. Retirement could last around 30 years, so your portfolio must support you long term, considering inflation and possible poor market returns. Your age pension provides stable income, so your strategy can focus on bridging the gap, with assets that offer steady income, preserve capital, and grow to keep pace with living costs.
Given high inflation, rising interest rates, and uncertainty, it's crucial your portfolio generates steady income, protects saving, and keeps up with the cost of living. With 5 years until retirement and moderate risk tolerance, we recommend a diversified, balanced investment approach. The first key asset we recommend is high-quality dividend-paying shares. These come from companies in stable sectors such as healthcare, utilities, and consumer staples. These stocks generally maintain their value during market volatility and provide steady dividend income that helps counter inflation's impact. Second, we'll incorporate short to medium-term bonds that are currently offering attractive yields. Their shorter durations will protect us from volatility if rates change in the coming years. Lastly, we'd recommend you to look at Australian real estate investment trusts that offer solid rental income and some protection against inflation. Further, they're more flexible than owning property directly. This mix supports your 4% withdrawal plan, manages risk, and helps ensure your money lasts throughout retirement, even with the current market challenges.
To meet Jane and Gabriel's retirement income needs, we created an asset allocation strategy balancing risk and return based on their moderate risk tolerance and 5-year time horizon. Fixed income accounts for approximately 50% of the portfolio, primarily in Australian government and investment-grade corporate bonds. With the RBA's cash rate at 4.35%, these bonds provide attractive 4 to 5% annual returns, delivering consistent income while reducing volatility. We allocated 30% to equities, focusing on high dividend Australian stocks and global blue chip companies. These can generate 6 to 8% long-term capital growth to help offset inflation, currently at 3.8%, above the RBA's 2 to 3% target. To manage liquidity and diversify further, 10% is held in cash and term deposits for short-term needs, while the remaining 10% is invested in alternatives such as rates and infrastructure, providing inflation-linked income and portfolio resilience. While equity markets face risks from global uncertainty such as China's slowdown and possible US recession, and bonds face interest rate risk if inflation remains high, our diversified structure helps mitigate these risks.
Asset allocation is designed to reach the retirement goals with moderate risk. It's made up of 40% equities, 40% fixed income, 15% in cash and term deposits, and 5% in alternatives. Equities aim to deliver long-term growth and dividend income, helping you stay ahead of inflation. Fixed income adds stability and dependable returns, especially valuable in today's higher interest rate environment. Cash provides easy access to funds for short-term needs without exposure to market swings, and alternatives such as REITs and infrastructure offer diversification along with inflation-sensitive income. Together, this well-rounded mix supports a steady 4% annual withdrawal strategy, helping to preserve your wealth while delivering the income, peace of mind, and long-term financial security you need in retirement.
I will share the key benefits and risks of your asset allocation plan. Growth through equities positions your portfolio to keep pace with inflation, while bonds and alternatives offer stable income through consistent cash flow. With flexibility, cash allocation supports both planned and unaccepted needs. Diversification spreads risks to reduce overall portfolio volatility. On the risk side, markets may go up and down, and the property values can be sensitive to interest rates. Active management is also important for the financial goals. This plan supports your 4% withdrawal rate and a long-term financial security. That's all our plan. Jane and Gabriel, we hope you like it.